In the previous example, we made two adjustments to net income to get to operating cash flows. This was just a simple example of the indirect method so we could understand the basic concepts behind it. However, there's actually a ton of other items we need to make adjustments for generally. To understand these adjustments, we need to understand how we account for different items. So the first thing we'll cover is non-cash expenses. If we have a non-cash expense, we know that expenses decrease net income, but if it's non-cash, that means no cash will be exchanged. So in turn, if we're trying to adjust net income to a cash basis, we would have to add back non-cash expenses. So example of this is depreciation. So if we think about depreciation or even amortization, we're just allocating the cost of an asset over its useful life. So let's just say, for example, we buy a building for $100,000. Right? We know when this occurs, we debit building, and we credit cash for $100,000. And let's just say the useful life of this building is 10 years, there's zero salvage value. So if we use the straight line method of depreciation, we would take this cost of $100,000 and we're splitting it over its 10-year useful life. So we end up recognizing $10,000 of depreciation expense each year. All right, so we debit depreciation expense and we credit accumulated depreciation. Both for $10,000 every year. So you'll notice here when we're making this journal entry for depreciation expense, no cash has been spent, right? We spent cash when we bought the building for $100,000, but this would be an investing cash flow. Right, so for depreciation alone, it's a non-cash expense. Since this will decrease net income, but no cash is actually paid, we need to add this back to net income to get to a cash basis. Right, we could also apply the same exact concept over to amortization, since amortization is just the allocation of the cost of an intangible asset over its useful life. Okay, so for amortization of bond discounts and premiums, right, if you recall back to chapter 14, when we amortize a bond discount or premium, it affects the amount of interest expense we recognize. However, the amortization of bond discounts and premiums don't affect the actual amount of cash that we pay for interest. Right, so since the interest expense will be recognized in net income, but not all of it will affect our cash payments, that means we need to adjust net income by the amount of discount or premium amortization to get net income to a cash basis. So if you recall, then when we amortize a bond discount, it means we end up recognizing more interest expense. However, the amortization, if it does not reflect an actual cash payment, then that means we would have to add the amount of discount back in to get net income to a cash basis. Okay, a bond premium is just the exact opposite. When we amortize the bond premium, that means we ended up recognizing less interest expense. Right, and so then since net income reflects the interest expense, we would have to subtract out the amount of the premium amortized. Another way to see this is if we just look at the journal entries for amortization. So if you remember, on any interest payment date, we end up amortizing some of the discount or the premium. So if we had a premium, we ended up debiting interest expense. We debit the premium on the bonds payable, and then we ended up crediting cash. Here, since we know debits must equal credits, right, the credit to cash here, or the amount cash will paid out, will be less than the interest expense. So that means we would have to subtract out the amortization of the premium from net income to get to a cash basis. If we look at the journal entry for discount on the interest payment dates, we again end up debiting interest expense, but then we end up crediting the discount on the bonds payable, and we end up crediting cash. Again, since we know debits must equal credits, that means our credit to cash here will be less, or will be less than our interest expense. Right, and so the difference between the two is the amount of the discount amortization. So we would have to add back the discount on the bonds payable to net income to adjust it to a cash basis. And then the last non-cash expense we'll go over is stock compensation expenses. So stock compensation expense, if you remember, we're just going to compensate our employees with stock options or restricted stock. Again, if we think back to the accounting for these, we'll determine the fair value as of the grant date, and then we end up expensing the fair value over the service life. Right, so if we think back to stock options, on the grant date, there was no journal entry. And then at the end of each year, we ended up expensing or recognizing this stock compensation expense. So adjusting entry at the end of each year, we ended up debiting stock-based compensation, and then we ended up crediting PIC stock options. So you'll notice here with this journal entry, we've recognized an expense with the debit. With our credit, right, we're not paying any cash. So with the stock-based compensation, since it'll reduce net income, but we're not actually paying cash for it, we're going to add back stock-based compensation expense. Other than non-cash expenses, there are some other non-cash items that we need to deal with. So the first is an investment that we account for using the equity method. If you took me for intermediate 1, we may or may not have covered how to account for equity investments, depending on whether we had enough time. But you should still understand how this works if I give you just this brief, if I briefly go over this. So when a company owns between 20 to 50% of the stock of another company, they end up accounting for the equity investment using the equity method. So we're going to use this equity method. Now the equity method just means that we increase our investment account when our equity in the company we invested in increases. And similarly, we'll decrease the investment account when our equity in the company decreases. So for example, let's just say we own 30% of the stock of Google. And we have a significant influence over them, so we'll use the equity method. All right, and then let's say in a year, Google reports net income of 100 million. All right, since we own 30% of Google, if they have net income of 100 million, this means our equity in the company increased by 30 million, right? So if we own 30% of the stock, 30% of that net income goes towards increasing our share, or it increases our share. So our equity goes up by 30. And that's just 130 million times the 30%. Right, since our equity went up by 30 million, that means we'll end up increasing our investment account by 30 million. Right, and our credit here will just be to investment revenue. So you'll notice here with this journal entry, we've recognized the investment revenue, but we have not gotten any cash for it. So in other words, if we report investment revenue from the equity method, we would have to subtract this from net income to get to a cash basis. All right, now let's just say if we flip this around, Google reports a net loss of 100 million. So if they have a net loss of 100 million, our equity goes down by 30 million. Since our equity in the company goes down, we would end up crediting investment for that $30 million. And our debit would be to investment loss for 30 million. Right, again, since this loss hasn't affected our cash balance, but it reduces net income, if we want to adjust net income to a cash basis, we would have to add this loss back in. The next item is unrealized holding gains and losses. For some investments, unrealized holding gains and losses will be reported in net income. For some others, they end up getting reported in OCI. So we're only going to adjust for unrealized holding gains and losses that get reported into net income. And so this occurs when we own less than 20% of the stock of another company, or in other words, we account for something like a trading investment. All right, so unrealized holding gains and loss just means that there's a change in the fair value of an investment, but we haven't yet sold the investment, and when we sell the investment is when we'll get the cash. But if we're still holding on to it, then that gain or loss is unrealized because we haven't sold it. So it's the change in the fair value of an investment that we haven't sold yet. So for example, let's just say we have a security, we're accounting for it using the fair value method. For the sake of a simple example, let's say we have 1 share of stock. Fair value at the beginning of the year is $20. And then let's just say fair value at the end of the year is $50. Right? In this case, then the fair value went up over the year by 30. If we haven't yet sold this, this means we have an unrealized holding gain equal to $30. Right? Since the since the unrealized holding gain here is $30, if we account for it using the fair value method, we're going to end up increasing our income by $30. However, we don't actually get the cash until we sell it. So since we've increased net income by this $30 here, but we haven't yet received it in cash, we would have to decrease our net income by the unrealized holding gain to get to our cash flows. The last non-cash item we'll cover is a loss on impairment of an asset. So a loss on impairment of asset, if you think back to impairments, it means that an asset has lost some of its usefulness, so we're going to end up reducing the value of the asset. Right? And when we reduce the value of the asset, we'll book a loss along with it. So this is kind of similar to kind of depreciation, where we're decreasing the book value of an asset, but no actual cash is being paid out. So then if we have a loss on impairment of an asset, we need to add that loss back into net income to get over to a cash basis. If it helps, we can just look at a brief example here. So let's just say we have equipment has a book value equal to, let's just say 600,000. Right, when we do an impairment loss test, we go through a two-step process. So step one was the recoverability test, where we're asking, can we generate enough cash with this asset to at least recover the book value of the asset? So we're comparing two amounts. Those are undiscounted future cash flows less than the book value. Right, and if our undiscounted future cash flows are less than the book value, then right, we wouldn't be able to generate enough cash to cover the book value, so then we can move to step two. Right, if we answer no to step one, then there's just no impairment. So in step two, we compare the book value to the fair value, and our impairment loss is the amount by which the fair value is less than the book value. Right, so let's just say our fair value here is $100,000. So we would have an impairment loss equal to $100,000. So in this case, to journalize this, we would debit impairment loss for $100,000, and we end up crediting accumulated depreciation. So you'll notice in this case then, when we go through the accounting, cash is not affected by the impairment loss. So add this loss back into net income to get to a cash basis. All right, so we covered how to adjust for non-cash expenses and other non-cash items on the previous slide. Other potential adjustments we'll make are for changes in current assets. Right, so earlier we said that for net income, right, we added back, or we subtracted out an increase in our accounts receivables. More generally, we're going to add the change in current assets. Or sorry, we're going to subtract or take out the change in current assets to net income. When I say change in current assets, I mean take the ending balance and subtract out the beginning balance. Right, so for example, if AR increases, right, our ending balance will be greater than beginning balance, so we subtract it out. If, however, your ending balance is less than your beginning balance, then we end up with a negative number for the change, and so we add in a decrease in our current assets. So again, we already talked about accounts receivables on the previous slide. So if AR increases, again, that means some of our sales we did not collect in cash. So then if we want to adjust net income to a cash basis, we have to subtract out this increase in AR. All right, for prepaid expenses, if we think about the accounting for these, let's just use an example real quick. Let's say we have prepaid supplies, so we buy $100 of supplies. When this occurs, we would debit supplies for $100 and we credit cash. Notice here we haven't yet recognized an expense, but we've definitely paid cash here. So if we see our supplies goes up, or if we see that our supplies go up, it probably means we spent cash on them. All right, so with the prepaid expense, we need to subtract out the change in our prepaid expenses. We could use the same logic for our inventory. So let's just say we purchase inventory for $100,000 or $100 as well. Again, we would debit inventory for 100 and our credit to cash is $400. Again, we haven't recognized an expense related to this until we actually sell the inventory. So again, if we see our inventory go up, we need to decrease the income by the amount of the increase. And so we'll also subtract out the change in inventory. Now, a possible question you might have is, well, what if we paid for the supplies or inventory, but we paid for it on account? So if we didn't pay for these current assets in cash, pretty much we'll adjust for this when we actually adjust for the payables. So earlier then we said, for example, if we bought inventory of $100 on account, then we'd end up debiting inventory for 100, and we're going to end up crediting our accounts payable for 100. So all else equal, we said if our accounts payable increases by 100, it means some of our expenses we wouldn't have yet paid in cash. So then we would adjust net income up by the amount of the increase in AP. So ultimately, when we go to adjust for your other balance sheet accounts, all these supplies or current assets we didn't pay for in cash will be captured by our adjustment for the payables. So to recap then, we'll subtract out any changes in current assets. I don't know why I put the prepaid expenses inventory up here since it's captured in current assets, so I'm going to delete this. All right, so the next thing we need to account for are changes in our current liabilities. All right, so we'll add back any changes in current liabilities. So earlier we talked about an increase in accounts payable. All right, and we said an increase in accounts payable means we probably booked an expense, but if we paid for it on account, that means we didn't pay any cash. So in other words, we probably booked an expense which brought net income down, but if we didn't pay for it in cash, we need to add that expense back to get net income to a cash basis. So increase in AP then, the cash paid is less than our expenses. So add back increase in AP. So we can apply this same train of thought to pretty much all of our other types of payables. So again, if we accrue a liability, we're usually, but not always, debiting an expense. So for example, if we accrue salaries and wages payable, right, when we do this, we end up debiting salaries and wages expense, and we end up crediting salaries and wages payable. As we can see here, we've recognized an expense, but no cash has been paid, so we would add back the change in the payable from net income to get to cash flows. The last item we'll cover here is gains or losses on the sale of investments, or PP&E. Okay, so when a company sells investments or PP&E, as we saw earlier, this should be classified as an investing activity. Right, however, if we have a gain or a loss from the sale, these are reported in net income. So if we're trying to adjust net income to an operating basis, this means that any gains or losses that aren't operating activities need to be removed from net income to get to operating cash flows. All right, so we need to remove gains and losses not related to operating activities. All right, right, just so we have a refresher of how we calculate gains or losses on investments or PP&E. The gain or loss is the amount by which the sale price is greater than the book value. All right, so if we sell, say, a building for $100,000 and the book value is, say, $90,000, we have a gain of $10,000. Again, the book value of something for equipment or PP&E is just the cost minus the accumulated depreciation. All right, so let's just say we have a building. The cost is $100,000. The accumulated depreciation is $20,000, and the sale price here is, let's just say, $90,000. Okay, when we go to account for this, since we're selling the building, we need to take any accounts associated with the building off of our books. So we'll credit the building account. Since the building stays at its cost of $100,000, we need to make a credit for $100,000. We also need to take the accumulated depreciation account associated with this building off of our books. Since accumulated depreciation has a credit balance, we're going to end up debiting the accumulated depreciation on the building for the balance of $20,000. Right. In this case, we know the sale price is $90,000, so we're going to end up debiting cash for that sale price of $90,000. And then finally, we know our debits must equal our credits. Our debits right now are at $110,000, our building's at $100,000, and so the difference here will be the gain on sale of the building. Right, and this $10,000 gain is just the difference between our sale price and the book value. So our sale price is $80,000, book value here, cost minus accumulated is $80,000, so it makes sense that the gain should be $10,000. Okay, so again, this gain gets reported into net income, but the sale of a building is not an operating activity. So to adjust net income to operating cash flows, we would have to subtract out this gain. In contrast, if we had a loss, we would add that loss back in. Another possible adjustment we would deal with is how to adjust for deferred taxes. We're not going to go too into detail into this, but if you remember back to chapter 19 when we covered income taxes, income tax payable was the amount that is immediately due to the IRS, and then our debit to income tax expense is our income tax payable plus or minus the change in deferred taxes. Right, so kind of the big picture here is for deferred tax liability, we could really just think of a deferred tax liability kind of like a payable, right? It reflects future taxes that have to be paid to the IRS in the future. So if a DTL increases, we're going to end up adding back that increase in, because if we look at this journal entry here, a increase in a DTL is going to end up increasing our income tax expense, but since the DTL reflects cash to be paid in the future, this increase to the income tax expense will be paid in cash in the current period. Right. Similarly, if we have a decrease in a DTL, we could think of it just kind of like a payable. You're going to subtract out the decrease in the DTL. And then the last adjustment we'll deal with is for pension expense. Same thing for pension expense. We're not going to go too far into detail into this, as going over all the components of pension expense is going to take quite a bit of time. But if you think back to the chapter where we covered pension expense, all these components of pension expense here are non-cash items. All right, so for example, if you think about service cost is the increase in the future projected benefit obligation from our employees providing another year of service. So the company ended up booking increase in pension expense due to the service cost. However, the cash paid out for that service cost won't be paid until several years into the future. Right, so pension expense, we will add back the amount of pension expense into net income. However, when we account for pension expenses, a company does pay out cash when it makes contributions to the pension fund. However, when a company makes these cash contributions, we didn't recognize an expense for the cash contributions. So when we deal with pensions, we'll add back the pension expense to net income, but we'll subtract out the amount of the cash contribution.